Okay, so let's dive into, you've probably seen the headlines. I mean, everybody's talking about this.
Right.
This market sell-off after these big tariff announcements.
Yeah.
And we're not just going to rehash the news that you've already seen. We really want to unpack what does this actually mean for you listening right now and for the broader economy?
Exactly. And Thursday, it was a real shock to the system. I mean, we saw the S&P 500, lose almost 5%. The Dow Jones Industrial Average down a whopping 1,679 points. The NASDAQ, down 6%.
Whoa.
I mean, that's the worst single day loss that we've seen in 5 years. So,
Yeah.
we need to understand what's driving this and, what's behind it.
And it all boils down to this central conflict, right? President Trump believes these tariffs are going to be a big win for American industry.
Right.
But the market is saying something totally different.
Exactly.
Right, like investors are not convinced at all.
Mm.
So that's what we want to dive into today. And we're going to be using this article, Stocks Are Cratering After Tariffs,
Yeah.
to kind of guide us through this analysis.
Absolutely. And right off the bat, the message from investors is loud and clear. I mean, they hate this trade war. They don't like this.
Okay, so let's dig into this.
Yeah.
Why such a negative reaction? Like what's the underlying link that makes investors hit the sell button when they hear tariffs?
Well, at the end of the day, the stock market is driven by earnings growth, right? So investors are buying stocks because they believe that the companies that they're investing in are going to be more profitable in the future. And tariffs really threaten that. So think about it. Tariffs can increase the cost of materials, components, things that companies need to make their products.
Okay.
So that squeezes their profit margins.
Yeah, right.
They can also lead to higher prices for consumers, and that can, reduce demand.
Yeah, of course.
So you have less profit, and that makes stocks less attractive.
So it's like if companies are facing higher costs or selling less,
Right.
then their bottom line takes a hit.
Yeah.
And that means lower stock valuations.
Exactly.
Now, the article mentions some pretty interesting analysis from Goldman Sachs, right?
It does. Yeah, they estimated that for every 5 percentage point increase in the tariff rate, S&P 500 earnings could fall by 1 to 2%.
Whoa!
So you think about it, the U.S. tariff rate is now around 20% after these announcements.
Yeah.
And so you can see how those potential declines in earnings could add up pretty quickly.
Yeah. Right? It's not just a little blip, it's a real...
This is a big headwind for corporate earnings.
Yeah, for sure. And the article also quotes Michael Farr.
Yeah.
And he has this very memorable phrase. He says...
protectionism feels good, but it's expensive.
Yeah.
And I think that really gets to the heart of the matter here. While there might be this idea that, protecting domestic industries is a good thing, the reality is that these measures have very real costs.
Mm-hmm. Yeah.
We could be talking about higher prices, for everyday things that you buy.
Yeah.
Reduced competitiveness for U.S. companies in the global market.
Right.
And then there's the potential for retaliation. Right.
Yeah.
So other countries could put tariffs on U.S. goods.
And then everybody loses.
Everybody loses.
Yeah, okay, so Farr is not predicting like a complete backdown or anything.
No, he's actually he's pretty measured in his outlook. He draws these comparisons to the Great Recession and the COVID pandemic,
Okay.
and reminds us that the market has recovered from some pretty significant shocks.
Yeah.
Before. So he suggests that, for investors who are, disciplined, have a long-term horizon, this could even be a buying opportunity.
Interesting.
So it's not all doom and gloom.
Okay.
But he does caution, that there are costs involved.
Now this raises a big question, doesn't it?
Yeah.
About this bull market that we've been in since 2009.
Right.
This sustained period of market growth.
Yeah.
It's been going on for so long, and the article calls it a secular bull market.
Right.
I mean, is this recent drop, is this the end of that, or?
That's the trillion-dollar question right there.
Yeah.
I mean, we've had an incredible run in the market since 2009.
Right.
I mean, just look at the S&P 500. It returned over 20% in both 2023 and 2024. Oh. So, that really highlights, the strength of that bull market.
Yeah.
But, when you look at 2025, the market's down, over 8% already.
Yeah.
So it does make you wonder if, are the conditions changing? Are we seeing a shift?
Yeah. Okay. So it sounds like in the near term, we should probably expect more volatility.
Yeah.
And maybe even more downward pressure.
I think that's a fair assessment. I mean, the article talks about how, the upcoming earnings season is always closely watched. But, we have to remember that the first quarter data isn't going to reflect the impact of these tariffs.
Right, because they were just...
Exactly. They just came out. So the real impact is going to start showing up this quarter in the results that are coming out.
And Bank of America, they've laid out some pretty...
They have
stark scenarios, haven't they?
Yeah, they've suggested that, S&P 500 earnings per share could fall anywhere from 5 to 32%.
That's a huge range.
It is a big range. And, a lot of it depends on whether or not we see retaliatory tariffs from other countries. That's kind of the thing that could really amplify the negative economic consequences for everyone if we start going back and forth.
And for everyday people like us, right? Like that means higher prices for everything.
Exactly. More expensive goods and services across the board.
Now, the article talks about how it's difficult to find historical parallels for this.
It does.
They even mentioned the Smoot-Hawley tariffs from the 1930s.
Right.
The trade wars that followed that.
Yeah. And Bank of America specifically, cautions against drawing too direct a comparison. We're in different times now.
Right.
But, Smoot-Hawley really serves as this reminder of how damaging protectionist policies can be.
Yeah.
When they trigger this widespread retaliation, and global trade collapses.
Yeah, nobody wins.
Nobody wins. And then the article also talks about, some of the secondary impacts, prolonged negotiations, the uncertainty that could really, dampen economic activity and even increase the risk of a recession.
Yeah.
And then there's this worry that consumers in other countries might boycott U.S. goods.
It's that principle.
Right. Yeah.
Okay, so it sounds like the risk of a recession, which was already being talked about, by some economists, is getting amplified by all this?
I think so. Tariffs, by making imported goods more expensive, they can contribute to inflation. And at the same time, the uncertainty that they create for businesses and the potential for, reduced trade that can stifle economic growth.
Yeah.
And that's kind of that toxic mix of stagflation that economists worry about.
Yeah.
And we're even seeing it, in the bond market. The 10-year Treasury yield has fallen significantly to its lowest level since October.
Okay.
And that often indicates that investors are getting more concerned about economic growth prospects. And, we all know what happens in a recession, right?
Yeah.
Businesses, they pull back on investment. Consumer spending drops.
People lose their jobs.
Yeah, people lose their jobs.
It's a downward spiral.
Downward spiral, yeah.
Yeah.
Okay, so Michael Farr uses this term repricing
to describe what's going on in the market right now.
Right.
Can you break that down for us? What does he mean by repricing?
So repricing basically means that, the market's initial valuations of companies didn't really account for the full potential negative impact of these tariffs. So they were
overvalued in a sense.
They were, I mean, investors had certain expectations priced into those stocks. And now with these tariffs, they're having to reassess and factor in these risks.
Yeah.
The higher cost, the lower demand, all these things we've been talking about.
Okay.
And that's leading to, investors selling off stocks to kind of bring those prices down to a more realistic level.
To reflect the new reality.
Exactly.
Okay. And even after the drop that we saw on Thursday, the article says that the stock market is not exactly cheap right now.
Right.
Meaning that there could be more repricing to come.
That's a really important point. Even with these big losses, a lot of stock valuations are still pretty elevated compared to historical averages. Okay. So, that suggests that if these negative scenarios that we've been talking about, if those become more likely, we could see further declines because investors continue to adjust their expectations and price in those risks. And Adam Hetz at Janus Henderson, he points out that, while markets have reacted, they're still far from pricing in the most negative scenario.
Oh, wow.
So there's
more to come.
There's potential for more pain ahead.
Okay, so for you, the listener, trying to make sense of all of this,
right?
What's the key takeaway here? What should they keep in mind right now?
I think the key takeaway is that, the market has reacted very strongly and negatively to these tariffs.
Yeah.
And it's not just a knee-jerk reaction. This reflects, fundamental concerns about earnings, about the risk of recession and stagflation and this just huge increase in uncertainty.
Right.
And the market is still adjusting to all of this.
Yeah.
And that process could take a while.
And while, we can look back at history and try to find parallels, this feels different, doesn't it?
It really does. The global economy is so interconnected today.
Yeah.
And retaliatory measures can be implemented so quickly that it makes, direct historical comparisons difficult.
Right. And the path forward is really unclear.
Very unclear.
Yeah. Okay. So here's a final thought for you, the listener.
Yeah.
To consider.
Okay.
Given the history of trade disputes and the ripple effects that they've created, what other unexpected consequences could these tariffs have on the broader economy and your own personal financial well-being?
Absolutely.
In the months and even years to come.
Yeah.
Think beyond just the immediate market swings.
Right.
Really consider those long-term implications for trade, for jobs, for the prices that you pay for everything.
Yeah.
Thanks for diving deep with us.
Thanks for having me.
Really appreciate it.
Absolutely.